Japan's economy is at a turning point. After decades of stability and predictability, a new wave of change is rippling through its financial system, catching the attention of investors and policymakers worldwide. For years, the Bank of Japan kept government borrowing costs extremely low, using aggressive monetary policies to stimulate growth and keep deflation at bay. This approach made Japan's government bonds some of the safest and most stable in the world. Now, interest rates on Japanese government bonds are rising to levels not seen in nearly 2 decades. This is a dramatic shift for a country long associated with ultra-low yields and a cautious approach to monetary policy. This shift has major consequences for Japan and the global economy. As the world's third-largest economy, changes in Japan's financial landscape can send ripples across international markets, affecting everything from currency values to global investment flows. It affects government borrowing, corporate investment, and personal savings. Japanese households, businesses, and even foreign investors are all recalibrating their strategies in response to these new realities. On December 8, 2025, the 10-year Japanese government bond yield hit 1.97%, nearing a symbolic 2% mark. This is more than just a number. It's a signal that the era of near-zero interest rates may be ending. This signals a change in investor expectations about Japan's future. Investors are now weighing the possibility of higher inflation, stronger economic growth, and a shift in the Bank of Japan's long-standing policies. The big question: what will the Bank of Japan do? Will it step in to control yields, or allow the market to set its own course? In the past, the bank would have intervened to keep yields down, buying up bonds and flooding the market with liquidity. This time, however, the situation is different. This time it's staying quiet, signaling a new strategy. The Bank of Japan appears to be testing the waters, gauging how markets and the broader economy will react to higher yields. The bank seems to view rising yields as a natural adjustment, not a crisis. It's a sign that Japan's economy may finally be strong enough to stand on its own, without extraordinary support. We'll explore why yields are rising, what the Bank of Japan is thinking, and how past and future policies shape this moment. Understanding these forces is crucial for anyone with a stake in Japan's future. For anyone interested in Japan's economic future, this is a critical issue. The choices made now will affect generations to come, shaping everything from job prospects to retirement security. It marks the end of one era and the uncertain start of another. The transition is filled with both risks and opportunities, and the world is watching closely to see how Japan adapts. The world is watching as Japan navigates these new financial waters. International investors, economists, and governments are all paying close attention, knowing that Japan's decisions could influence global trends. The Bank of Japan's patience is a story in itself. Its willingness to let markets adjust, rather than rushing to intervene, marks a significant departure from past practice. Investors, companies, and citizens are all feeling the impact. From the cost of mortgages to the value of pensions, these changes touch every corner of Japanese life. Understanding this shift is key to grasping where Japan's economy is headed. The stakes are high, and the outcome will shape not just Japan, but the global financial system. Let's dive into the forces driving this transformation and discover what the future may hold for Japan and the world. To understand Japan's current financial situation, let's break down the basics of government bonds and why they matter so much. A government bond is essentially a loan you give to the government. In return, the government promises to pay you back the amount you lent, plus a little extra in the form of interest over time. Governments use the money they raise from selling bonds to fund important public projects, like building roads, schools, hospitals, and other infrastructure that keeps the country running smoothly. The yield is the return you get for lending your money, shown as a percentage. It's a key number for investors, because it tells them how much they'll earn. Here's something important. Bond prices and yields move in opposite directions. When bond prices fall, yields go up, and when prices rise, yields go down. These price changes happen because of supply and demand in the market. If more people want to buy bonds, prices go up. If more want to sell, prices drop. When lots of investors rush to sell their bonds, prices can fall quickly, causing yields to rise as a result. Yields also reflect what investors expect about the future, especially inflation and interest rates. If people think inflation will rise, they'll want higher yields to make up for it. Rising yields mean investors are demanding a bigger reward for lending their money, because they see more risk or expect higher inflation ahead. For many years, Japan's central bank kept yields extremely low by buying up bonds and controlling the market, making it cheaper for the government to borrow. But now, things are changing. Market forces are starting to play a bigger role, and the central bank is stepping back. This shift means the government could face higher borrowing costs, and it could ripple through the entire financial system, affecting banks, businesses, and even ordinary people. Investors are now carefully reassessing the risks and rewards of holding Japanese government debt, weighing the potential returns against new uncertainties. The implications of these changes are profound, not just for Japan's government, but for its entire economy and everyone who depends on it.
Several factors are pushing Japanese bond yields higher, and together, they're reshaping the country's financial landscape in ways not seen for decades. The main reason is growing expectations that the Bank of Japan will soon raise interest rates for the first time in years. After a long period of ultra-low rates, inflation has returned to Japan, and it's sticking around longer than many expected. The economy is showing real signs of life, with consumer spending picking up and business confidence improving. This has led many to believe that the era of negative or near-zero rates is finally ending. Investors are now betting on a rate hike from 0.5% to 0.75% at the next Bank of Japan meeting, a move that would mark a significant policy shift.
When rate hikes are expected, investors rush to sell older bonds with lower interest rates, causing their prices to fall and yields to rise. This is a classic market reaction, and it's happening now in Japan. The anticipation of a major policy change is fueling volatility and uncertainty in the bond market, as traders try to position themselves ahead of the central bank's next move.
Another important factor is uncertainty about government spending. Japan's government is under pressure to stimulate the economy and support growth, especially after the pandemic. To fund new stimulus measures and infrastructure projects, the government plans to spend more, which means borrowing more by issuing new bonds. This increases the supply of bonds in the market.
When more bonds flood the market, prices tend to drop and yields go up, as investors demand better returns for holding additional debt. Investors are becoming more cautious, carefully analyzing risks, and demanding higher yields to compensate for the uncertainty and potential inflation. The combination of expected rate hikes, increased government borrowing, and a changing economic environment is creating a perfect storm in Japan's bond market. With so much uncertainty, investors are demanding more for holding Japanese bonds, and yields are likely to keep rising as long as these pressures remain.
Investors are nervous as the Bank of Japan steps back from controlling the market. The era of stability is over, and the market is searching for direction. Investors watch the 2% yield level closely. It's a psychological barrier. Some expect the Bank of Japan to intervene, others don't, fueling volatility. This speculation drives yields even higher.
The Bank of Japan's silence adds to the uncertainty. Investors don't know what level will trigger intervention. Without clear signals, speculation and sudden sell-offs are common. The market is adjusting to a new era without a central bank safety net. Rising yields reflect this messy transition. Until the bank or government clarifies their plans, nervousness will persist. Investors are recalibrating for a world where market forces matter again. The adjustment is bumpy, but necessary.
Government spending plans are crucial for the bond market. The current administration is expected to increase spending, requiring more borrowing.
More borrowing means more bonds issued, increasing supply.
Higher supply usually means lower prices and higher yields. Investors anticipate a large volume of new bonds, so they demand higher yields now. This expectation is already affecting the market. The balance between government spending and central bank policy is delicate. If the government borrows more while the Bank of Japan tightens policy, borrowing costs can rise sharply. The market is caught between these opposing forces. Investors are watching to see which will have the bigger impact. The outcome will shape Japan's financial landscape.
Despite rising yields, the Bank of Japan remains calm. In the past, it would have intervened quickly, but not now. The bank sees the rise as a healthy adjustment, not a crisis. Intervening would send mixed signals about its commitment to policy normalization. The bank avoids setting a line in the sand for yields, forcing investors to judge fair value themselves. This hands-off approach is key to ending its long stimulus program. The goal is to let market forces set rates, even if it's uncomfortable. Intervention will only come if the market becomes truly dysfunctional. For now, the bank sees the market as functioning, just nervous. This is a deliberate, strategic shift.
Governor Kazuo Ueda's statements reflect the bank's patient approach. He acknowledges yields are rising quickly, but doesn't call it dangerous. Ueda says the bank will act only if yields move out of sync with economic fundamentals. This reassures markets that intervention isn't automatic. Ueda's main goal is to provide clarity and manage expectations. He'll offer more guidance at the next policy meeting. Clear communication can help calm the market and reduce volatility. Ueda is steering Japan away from old policies without causing panic. His careful words are central to this transition. Japan's bond market is still adjusting to the end of massive stimulus. For years, the Bank of Japan used yield curve control, buying huge amounts of bonds to keep yields near zero. This distorted the market and suppressed volatility. In 2024, the bank ended these policies, letting market forces return. Now, yields are rising as investors find the true price of money. This transition is creating short-term volatility, but it's necessary for a healthy system. The bank's goal is now a smooth shift to normal policy, not suppressing yields. It's focused on managing short-term rates and overall stability. The era of micromanaging long-term yields is over. The Bank of Japan will keep watching the market closely. The next policy meeting and government budget announcement are key. Clear plans could help stabilize yields. If borrowing is higher than expected, yields may rise further. The interplay between monetary and fiscal policy will remain central. The bank will gradually reduce its bond holdings, moving slowly to avoid shocks. The challenge is to withdraw support without harming the economy. Rising yields signal Japan is moving past deflation and stagnation. The transition is risky, but the bank believes it's the right path. The world is watching as Japan navigates this pivotal moment.